again, good afternoon, good morning, wherever you are in this fine country of ours. My name is Graeme Allan, one of the wealth leaders at IDC, along with my colleague Alex Chan out west. We are really happy today to be bringing, should I say a superstar, Patrick? Let's see if we get a smile out of that. We're joking back screen about titles and so on, but it's very nice for us at IDC to have a prominent speaker today to kick things off. Patrick Blais is a senior portfolio manager at Manulife and has been in this business for 25 years. We'll come back to that, 15 of which has been at Manulife, and he's the head of the fundamental equity team. So he's going to go into some in-depth stuff today that I know is going to be interesting. I've heard Patrick speak before. It's always engaging, and there's always plenty of questions that come out of the presentation. I will be monitoring questions, and when the opportunity presents itself, I'll present those to Patrick and move forward from there. But finally, before we start, 25 years in this business really means something. That means that Patrick's been through cycles, understands what's going on, has an anticipation of what's going to happen next based on what's happened previously. That's one of the most important things I think an advisor should consider when hiring an investment manager is experience that manager's had managing money that the clients will appreciate and see grow for the future. So I'm going to stop things now because we're really looking forward to hearing Patrick speak, and we'll hand over to Patrick.
Great. Thank you, Graeme. Really appreciate the intro. Haven't been called a superstar yet. Don't let it go to my head, and don't tell my wife either. She'll dispute that term very quite vehemently. I guess thinking about the markets, thinking about investing over 25 years, I would say we're never sure, right, of what the future holds. But if you have a good process which focuses on the right things, and we'll get into that in a few minutes, I do think you can position portfolio to weather any type of economic environment. So that said, let me just bring up some slides that we've put together to go over a few items. I guess first and foremost, just to introduce myself. So yes, Patrick Blais, I head the fundamental equity team at Manulife. We manage, I believe it's actually, let's say close to 12 billion. It may be actually over 12 billion, given some recent wins, but let's say close to $12 billion. We manage significant funds for institutional clients, asset owners, so think pension fund, foundation, endowments, but we brought those capabilities to the retail space. What you have here on the screen, I presume everybody can see the screen. I do believe I have to put it in presentation mode though. Here we are. We do manage a number of retail funds. What's notable about our retail funds is they're all 5-star with the exception of one fund, which is 4 stars. So all 4 or 5-star funds. So quite successful when it comes to a long-term track record. There's some notable standouts here. For example, the Fundamental Balance Fund won the Lipper Award for best fund in its category over 5 and 10 years. All of these funds, most of them are top decile, if not second, third percentile over 10 years. But what's notable about them is the consistency. For example, Fundamental Equity, which is one of our flagship funds, our best ideas in Canada, matched with our best ideas outside Canada, has actually outperformed its category and the index 9 of the last 10 years. What's notable, it's the only fund to have done that. So not only strong long-term performance, but great consistency in delivering that performance. But that said, let's talk about the markets first, and then we'll come back to how we've delivered that performance and how we think our portfolio is positioned for the current environment. So I would say, if you heard me talk a few months ago, I'd say it's a little bit of the same theme. It's one, the key word is resilience, meaning the market's proven extremely resilient. You look at stock market indices, they had a great 223. They continue to power through in 224. Returns year to date are actually quite impressive. Now, I think we all know what's been driving those returns. One of them is the fact that inflation is coming under control. All right, go back a year. We were all quite worried about the ramifications of strong, high, persistent inflation because central banks had to raise interest rates to keep it under control. And we hadn't gone through such an aggressive interest rate cycle in decades. It was actually the most aggressive rate rise we've experienced in generations. But that said, fundamentals have remained quite resilient, as we'll see in a second. But now the market can look forward to actually inflation coming under control and rate cuts coming through. And we started to see that across the globe. But what stood out to us is the fact that GDP has stayed strong. In fact, in certain economies, such as the US, GDP has actually bounced back up. Now, I think if you were to ask us 2 years ago, I think we would have been surprised. I think to see GDP stay this resilient in the face of massive rate increases. And the question is, why has GDP stayed so resilient? I guess it comes down really to two aspects, which I like to keep my analysis simple. I like to bring down the economy to the two main driving factors, which is, at the end of the day, the consumer and corporations. When it comes to consumers, the truth is they're employed, right? If you look at employment levels, they're actually quite strong. In the US, unemployment is still below 4%, which is quite astounding, given the length of this low unemployment period. Secondly, the consumer continues to gain or benefits from wage gains that are actually ahead of inflation. We saw inflation earlier running in the threes, in the twos on core measures. But wage inflation is ahead of it. So we may dispute or we may complain about inflation, but the truth is, as long as wage gains are ahead of inflation, we're actually richer. That's at the end of the day the facts, right? So the consumer is in a relatively good place. Now the question is, will he stay employed? That's the key question. And for that, we need to look to corporations. How are corporations feeling? If you actually look at corporations, they went through quite a tumultuous period. You think about the supply chain disruptions brought about by COVID, by trade wars, notably the US and China, but I think it extends beyond that. We can think of Russia also being a significant disruptor to trade. And the truth is that's changing on a permanent basis, right? This globalization, liberalization, that's reversing. Secondly, real wars. Ukraine, Middle East have definitely disrupted some companies' operations and their supply chains. And of course, just COVID and the impact COVID had on supply chains. But companies have proven flexible. And I think it goes to speak to the ability of companies to adapt. Consumers as well. I do think part of the reason why consumer employment has stayed low is consumers adapt, right? The emergence of the digital economy, the ability to work two jobs, if not three, is a new reality. Well, in the case of companies, I think all of the investments that they've done in digitization, which was spurred or accelerated when COVID hit, because they had to change the way they operated, the way they interfaced with customers, the way they actually operated their business. They accelerated digitization. Anecdotally, every company we were speaking to was talking about having to digitize their operations. Well, I think that's paying off. I think what you're seeing is the ability of companies to re-engineer their operations, to shift their supply chains where it makes sense, and to adapt more efficiently, and which has led to better margins. And that's quite astounding when you think that they've recaptured and gone back to historically high margins even though they're facing the highest wage inflations they've ever faced in decades. Who would have thought that through pricing and by being efficient, more productive, they'd be able to recapture those margins when they're facing such strong wage labor cost inflation, right? So I think it just goes to speak that there's a lot of innovation, there's a lot of productivity coming through. And we actually see that in the numbers, right? If you look at productivity measures, we have seen a spike up. This chart shows you at the end, productivity, it was low, was sporadic. We've had a few quarters of actually positive productivity. And we're hopeful, I'm hopeful going forward that human ingenuity will continue to drive productivity. I think you're finally seeing a lot of that past technology come through, drive productivity. And we can be hopeful that looking forward to things like AI, solid state batteries, a lot of other new innovations that will continue to see productivity continue to deliver value. And productivity at the end of the day, what does it mean? It just means doing more with the same amount of inputs, or you know what, doing the same amount of inputs with the same amount of revenues with less costs, less inputs. But however you define it, what it means real wealth creation, right? We can bemoan the lack of productivity in Canada. I do think it is an issue. We are dependent on population growth for growth, but in places like the US, you're seeing a real spurt in productivity, in innovation, and that usually decimates globally. So hopefully we'll even help a place like Canada, where we seem to be lacking a little bit in that aspect. But quite hopeful on the overall markets. At the end of the day, the US does drive the majority of the markets. It is a big marketplace for even Canadian companies that we invest in. So that's really the market that we look at. Now, in terms of maybe what concerns us. So I've talked about the fundamentals. I actually think the fundamentals are pretty sound. You got a good consumer, you've got good companies. I don't think companies need to cut their workforce given their high profitability. They're actually looking to reorient their workforce to seize opportunities to grow. But there are risks out there. First one being debt levels. I actually think debt levels are too high. I think we've had decades of reliance on high debt. I think it was spurred by low interest rates. But the truth is, we're gonna need to really think hard as a society. What's the appropriate debt level? Debt level introduces a lot of risk and sometimes unacceptable risk. And I do find that we become a little too complacent. But with the rise in interest rates, I'm hopeful that it's something that we'll take seriously and that we'll manage it gradually down by growing mostly, but by being more responsible when it comes to debt accumulation. And it's really a global phenomenon, right? It's not just a Canadian or issue where we've levered to buy houses. You look globally, most regions, most economies have levered up. And we see that primarily, for example, in the US, where their budget deficit is sky high, unsustainable, right? I do think it's an issue that the next government will have to start addressing, because with high interest rates, it's unsustainable. And my fear is that the market may actually become very concerned and drive a significant risk premium on the issuance of new debt, and really pose some serious questions over the economy. So we need to see the US address the issue. I don't think it's going to happen in an election year. No potential president would start talking about reducing debt or raising taxes without or cutting spending in aggressive fashions that resolve debt issues. I think we're going to have to wait for the new administration to really realize the seriousness of the issue. Now they need to get the budget deficit and ultimately debt levels under control. But that is one of our key worries. In Canada, it's an even higher worry. I think we all know that Canadian consumers are more levered than their US counterparts. And the fact is, our US counterparts benefit from mortgages that are 30-year fixed. In Canada, we don't have that benefit. We actually have 5-year fixed, and many individuals have variable, though that has diminished, variable interest rate. So therefore, the sensitivity might be less. But at the end of the day, we need to renew mortgages every 5 years at the prevailing rate. And that's causing the consumer to come under pressure. We're seeing it in the data where consumer spending in Canada is slowing down quite significantly, and it's basically having an impact on GDP growth. So we are seeing the sensitivity of the Canadian economy to higher interest rates. Just maybe moving on. Last risk is actually interest rate and inflation. The truth is, I do think inflation is under control. I think the data proves that point. We're seeing it. But that said, it's proving persistent. What we see here are the 5-year forward inflation, which to me is a good, reasonable sense of expectations and where we will be for years to come. And what you see is that inflation may be under control, but it's there. And that means that probably interest rates can't come down as much as we think, which poses some serious questions, right? Over, okay, how you manage economy now that can't rely on excessively low interest rates, right? So it makes you rethink how to run a business, how to manage the economy, and how to invest. So I will say inflation pressures, I think, will stay. I think they're partly driven by deglobalization. In the past, inflation was low in my mind because we could basically move our manufacturing to low-cost jurisdiction. That option is less available for 2 reasons. One, deglobalization. Companies, because of supply chain issue, war, realize that they want their supply chain to be resilient, and the best way to do that is to bring it back closer to onshore. And secondly, demographics. Populations are getting older, not just developed markets, but even places like China are actually aging quite quickly. And that means that there's there's a lower labor pool, right? Which means that wage earners do gain negotiating power, and therefore will probably get some wage growth that will drive inflation. So interest rate will probably have to stay higher than we think to manage that. I'm not saying higher from here, but if I was to think about the biggest risk is the fact that we can't cut interest rates back to where the market expects, where the market would be comfortable to support current asset prices, which comes to my next issue, which is valuations. Hey, the run up in the stock market's been great, right? We all feel richer. It's increased our net worth. But the truth is, valuations have gotten, I think, a little on the high side. Not excessively so, but enough that I think, say with a level of confidence, nothing's really cheap anymore, or markets in general aren't cheap. And there's definitely pockets of overexuberance. We see that. And it really comes down to really making sure that you're not buying expensive names and that you're finding the names that are where you've got adequate valuation on your side. We are seeing some dispersion across regions. For example, like a place in Europe is cheaper. And if you look in our funds, you'll see that we've accentuated Europe. Why? Because we're finding great companies that are cheaper than the US counterparts, and yet they do the same thing. So we're taking advantage of that discrepancy. And last but not least, when it comes to valuation, like I said, don't rely on cutting interest rates to support valuations in general. So don't buy the market. Really pick your stocks and pick your stocks well, because one, you'd have to cut interest rates a lot to go back to previous relationship between interest rate and equities. And the truth is, I'd be careful betting on massive interest rate cuts. We saw just this morning inflation figures in Canada that really question the ability of the Bank of Canada to cut rates aggressively from here on. So that said, what can we do about it? So I've talked about the markets. I've talked about my views where I think the fundamentals are good, but valuations aren't so great, and there are risks out there, but there's always risks, right? And anyways, we're paid to take risk. So how do we manage these environments? So we have the reasons pension funds, endowment funds, foundations entrust money with us, and hopefully you would entrust money for us, would be, yes, for the long-term returns that we've generated, but for the way that we generate those returns, meaning, in a way where we take appropriate measures, appropriate risk, and we get paid for the risk that we take. And I think nothing proves that point better than the fundamental equity fund, which is representative of our other funds, which has beaten 9 of the last 10 years, the market and our average peer, and the only fund in its category to have done that. Well, we've been able to do that because first and foremost, we have the right team. So 8 individuals. And what's notable about our team is we work together and we make sure that we stay honest to our process. All of us are analysts, all of us research new names, but all of us manage the portfolio together, meaning we sit around and we question ourselves. Are we building the right portfolio? Are we putting the right names in? And the right names really comes down to really one thing. How much cash will this company generate? But not any cash, the real underlying cash. And for us to get to that number requires a lot of work. We'll typically take the last 10 years of a company's financial statements and we'll go through it. We'll redo those financial statements and we'll get to the real cash a company generates. And if I have that number, I think I've got the real facts of the business and I can figure out the 3 key things that are important to me. First and foremost, is it a quality business, right? Because nobody wants to buy bad businesses. We want to all buy good quality businesses. But if I know how much cash it generates and can they continue to generate high levels of cash going forward, then I know that I've got a quality business. Secondly, how much risk am I taking? I'm a big believer that a stock will follow where the cash is going. And if I understand what are the risks to that cash, I understand the risk that I'm taking. And if it's too much risk, I probably won't buy it, right? It's great to have a good idea, but if things go wrong, that cash can be down 80%. The stock can be 80% down. I probably don't want to take that risk. So I'll find a better idea where I get the same upside, but with less downside risk. And then thirdly, valuation. You can't overpay for stuff, right? At the end of the day, I actually think stories, sentiment drive the markets. And that's why markets are efficiently valued between plus 100% and minus 50%. But what you want is a really good process that allows you to figure out this is what a stock is worth and take advantage of that emotion in the market. Don't buy the names that are overvalued, but really find those names that are undervalued, that are good quality businesses with less risk. And I think that's what we do well. If you look at our portfolios, what you'll see is we really accentuate quality. We show that on the horizontal line. Further to the right, that's the highest quality names. And then valuation, the higher, the better. And what you see is our fund is in the upper right. Our 40-odd names, we built portfolios of 40-odd names, well-diversified, fully invested, and we keep that quality there. And what happens is stock moves, fundamentals change. Well, that's when the team gets together and reorients the portfolio to position it well so that we keep those 40 names in the upper right. And what that leads to are strong performing funds. So we talked about fundamental equity. This is one of our flagship fund. It's in the Canadian focus category. So it's our best ideas in Canada, matched with our best ideas outside of Canada. And as I said, it's added a lot of value. It's actually beaten the average peer by 3.3% over the last 10 years. So compounded, that's over 40% of outperformance over 10 years. This fund is actually second or third percentile in its category. But again, what I like about this fund and what I like about our process is that consistency, right? If you look at the bar chart at the bottom, again, this is what displays, right? We've beaten 9 of the last 10 years, the average peer and the benchmark. What does the fund look like? Again, well diversified. We've accentuated names in Europe. Why? Not because we like Europe in itself, but because, hey, there's a lot of well-valued, attractively valued, good businesses there that are high quality, low risk, and have great valuation on their side. So we're going to take advantage of that flexibility and go there. Then you see the sector distribution. What this shows you is we take good active share because we don't need to be in every sector, right? If there's no opportunities, we're not there. And if there are great opportunities, we will be there. So it's not sector driven, it's bottom up driven, but we take advantage of the opportunities out there. The other fund that's worth noticing is Fundamental Balance. This is the one that won the Lipper Award for best fund in its category over the last 5 years, over the last 10 years. Best selling fund in its category, by the way. So thank you very much for those that are supporting this fund. But again, same profile as fundamental equity, right? It's the same equity portion as fundamental equity, but then it's matched with our standout fixed income team at Manulife, the Canadian fixed income team. So together we add value in a 65-35% portfolio, typically a little bit higher on the equity side, 68, 69%. Sometimes we'll go up to 72 when markets get really cheap, but we take advantage of market opportunities. And again, that same consistency you see in the bar graph, added a lot of value over 10 years, but the bar graph shows you that consistency of beating the market in the average peer 9 of the last 10 years. What does the fund look like? Very quick on asset mix. This is where we stand. Again, Canadian equities, US equities, taking advantage of Europe, invest in bonds. And on the fixed income side, well-diversified bond fund that takes advantage of credit opportunities in the market. So on that note, I think we've wrapped up the prepared statement. I think I'll open it up for question. I believe Graeme, they asked me to talk about my skiing adventures at one point, but let's open it up for questions. And in the interest of time, if we have time, I'll talk about my ski adventure.
Are both these funds available inside the segregated fund platform at Manulife?
The answer to that is yes.
Okay. And to the person that obviously asked that, Kimberly is the person's name. If Kimberly, you'd like to get in contact with myself or Alex, wherever you're located, we can certainly get you in contact with the local Manulife wholesaler to go into that stuff in a bit more detail. That's not a problem at all.
I know our wholesalers love to mention that fundamental balance is offered in the class structure as well. Apparently, it has massive tax advantages for certain individuals out there, especially people who run mid-sized businesses or the like.
There may be able to be some people on the call that are dual licensed, so that might be the magic words that gets more inquiry for that as well. So, Alex, is there anything that came to mind question-wise from yourself?
Yeah, well, actually, it's something that Patrick shared with us a few months ago when he was in Vancouver, and I thought it was really great because when portfolio managers manage money, they always talk about the risk reward. And I think Patrick alluded to that he would share this story, and I thought it was quite amazing. So, Patrick, the whole risk reward and how you handle it and your personal experience with risk and reward would be great.
Sure. Yeah. So as I said, right, I think the key to our success, we grew through from a few hundred millions to over 12 billion was not because of the returns we delivered, but because of the risk return profile. And what that means, again, I'll really emphasize, taking measured risk and making sure that you're paid for the risk that you take I think there's a value proposition in that. Taking too much risk, at the end of the day, you're putting a lot of your capital at risk, right? It's important to, be able to handle volatility and stay in the game. So taking measured risk is always appropriate, and you want to limit that downside risk, those extreme events, right? That can really hinder your portfolio, and get good returns. So good returns, they're good, but they're not great if they come with too much risk. And I guess a couple of months ago, but actually beginning of January, I went to Whistler with my daughter. So I come from Quebec City, big skiing family, and I want to introduce my daughter to great skiing. And what better place to introduce her than Whistler? We've been skiing in the region of Toronto. As you know, the hills in Toronto are not the most challenging. And my daughter's at a point where, hey, she can challenge herself. Get to Whistler. Unfortunately, my daughter fell sick, so she couldn't ski. So we had 5 days of skiing. So my daughter stays with her mother, my wife, and off I go. So didn't have a bad time, right? Here I am skiing at Whistler by myself. Don't have to take care of my daughter. Wish I'd been with my daughter, but make the best of it. I'm having a great time, right? And I'm starting to feel younger and younger every day. Starting to remember what it means to ski, and I'm not that young of a man anymore. And then I meet up with in a gondola with some very young people, and I start skiing with them, and I start sort of pushing myself and doing some stuff that I hadn't done in decades. Last day, big snowstorm. We're out on the hill. They open up everything, and then we get to this big bowl. I don't know the names of the bowl at Whistler. I was just following them, and I kid you not, it was literally a cliff, and then the bowl started. And I made a joke, hey, if one of you goes, I'll go, thinking nobody would go. Lo and behold, one person went, and I felt compelled. I mean, at the end of the day, I've got to keep my reputation in front of these young kids I'll never see again. I say, hey, I guess I got to go. So I looked what he did. Figured, I can do that again. So I jumped the cliff. Bad idea. I was like flailing, landed in the bowl, almost blew out my left knee, but hey, I still landed, and then I skied down the bowl and managed to survive. And you know what? It was actually a thrilling experience. Felt great. Felt like, hey, I'm on top of the world. So then I go back to the hotel room. Then I tell my daughter, right, the story of the bull, the cliff that jumped, and tell her that I was flailing, that I almost blew out my knee. Then my daughter looks at me, and after, remember, she's 13 years old. She goes, "Dad, I don't get it. At work, you always talk about is the risk worth the return, or is the return worth the risk? And here you're telling me that the return of doing a bowl was worth the risk of whatever you went through. You don't make any sense, Dad." So I was surprised, I have to admit. The fact that my 13-year-old daughter actually understood the concept of risk return, knew what I did, and knew how I thought was actually enlightening. Very proud, but she was right. Probably the risk was not worth the return, especially when you're not 20-year-old anymore, and you probably don't have the same capabilities that you think you have. So there's my story of risk and return. Take appropriate risks to get the returns that you want, and maybe jumping a cliff is not a good idea.
So we have two quick questions before we have to let you go. First one here: are your fund holdings protected in terms of a scenario where the Fed misfires and triggers a larger than expected slowdown?
Yeah. So good question. At the end of the day, we always, as if the only thing you can really control is valuation, and it's a key word, right? Because sometimes the most cyclical stocks that are exposed to risk may actually be the less risky, because they're already pricing in that risk, and that's what we do. So, for example, if you look at our holdings, you'll see names there that you know what, they are exposed to a slowdown if the Fed increases rates. But the truth is, they're already factoring that in. They're factoring in a consumer retail slowdown. Like a name that we really like that's in our fund is Lowe's. It's in our top 10. A lot of the slowdown's already priced in. So yes, it is exposed, but we think it's more than in the price. Mid 222, some of our best calls were basically buying cyclicals. Everybody thought we were going into a deep recession. We bought cyclicals that were dirt cheap from defensive. Why? Because we thought at worst they'd be up 25%, and at best they'd be up 90%. That's a great risk return profile, right? Everything goes wrong, you're still making money. And there's certain times where making those bets pay off. So focus on the valuation, focus on the downside risk, make sure you own quality companies. Typically things work out for you.
Okay, one more here from James. In your opinion, why don't countries, Canada and the US, no longer face up to their budget deficit/debt? Both Canada and the US seem to be laser focused in the late 90s to get their debts under control.
Yeah, so that's how many hours do we have? I think it's up to everybody's opinion, but I think there's been I think we've forgotten that there's a cost to debt. And I think it came from the fact that interest rates kept on coming down because inflation kept on coming down. But the risk has always been that, hey, the cost of debt comes back, and we are seeing it come back. And I think it will pose big questions for markets, governments, the economy. The promises that we've made, are they sustainable? Where do we need to invest? At the end of the day, we can't do everything. It's like anything else, right? You only have so much money. You need to allocate that money appropriately. And I think governments got to a point where they think they can do everything, and they think they can please everybody. And maybe it's in their personal interest, in the interest of their parties, for example. But I think markets will reimpose discipline, and there'll be hard choices to make. And not everybody will be happy, but I think that's better than continuing on this trend, which is unsustainable, and having to face up to what would be even more dire circumstances. So I do hope the market reimposes some discipline, and governments can continue to intervene where it's adequate, but in a fashion which is sustainable, right? It's great to help people, but you can't do everything because there's a cost to that.
Okay, so this is the very last question. No more from Elizabeth. Will the unrealized commercial lending losses at regional US banks be an issue?
So if you would look at our portfolio, you'd see that financials we're typically underweight. And if you look within our financials holding, you'd see that when it comes to the banking sector, we have actually minimal exposure these days. We're actually very low exposure. And the reason is because of credit risk, whether it's commercial lending or whether it's even consumer. We actually think a lot of the credit risk has to normalize. It's abnormally low. There's been a lot of lending. There's been a lot of risky lending. There's also commercial exposures that are starting to percolate beyond just real estate, and that basically has pushed us well, we've concluded that there's a lot of risk to invest within banking, not just U.S. regional banks, but banks in general. And we've got better opportunities elsewhere. If you look in our top 10, for example, our biggest financial weights would be something like TMX Group. They run the Canadian exchange, but that said, they're more of a data and analytics business now, over 50% of their cash. Turn from there, there's a cheap stock, great upside, little risk to credit, no risk to credit, and little operational risk. Those are the type of names that we're investing in right now.
Perfect. Well, you know something, I know we could listen to you for hours and hours if we had the time, but we don't. And I know you've got a rather important job to manage all these clients' money. The last words I would say to obviously the audience on stage here, something that you slipped in there, this is an opportunity for clients to get institutional management on a retail platform. And I think that's really, really important that advisors realize that they can access the expertise that typically you don't get on the retail side as a one-on-one. So I think that's just something to take away. I would like to thank you very much. I'd like to thank Manulife for giving us the opportunity to have you on the call today. I think that's just a fantastic, the partnership we have, Manulife and IDC. So Patrick, thank you. I do look forward to the next time we have the chance to listen to insights from you again. So thanks.
Right. Well, thank you, Graeme. Thanks, Alex. You guys are great. Thank you, everybody, for taking the time to listen, and hopefully we'll talk soon.
Perfect.
Great. Thanks, Patrick.
Take care. Bye.
Bye.
You soon. Take care.
Okay, people. So just to keep things moving on, it is my distinct pleasure to introduce my colleague. And I wouldn't say a colleague, I'd say a friend, a dear friend of mine. I look to Alex for many things in the daily duties that we have. And one is his insight and the analysis Alex has of certain things. And I do know that the next 15, 20 minutes are really going to be insightful. So Alex, over to you.
Great. So again, thanks for joining us today. And again, Graeme didn't mention this, but I'm sure he was going to mention it later. We've been having a fabulous year on the seg-fund front at IDC WorldSource. So we would like to thank everybody on the call for their continued business and support. So one of the things that I talk a lot about and Graeme talks a lot about, and the industry really challenges us, on the seg-fund side, is this whole thing around, fees. So the title of my presentation today is What the F, with the F, talking about fees, MERs. And also I'm going to talk about the value of advice that all of you provide to your clients as a financial advisor. And I've also uncovered some low fee seg-fund options, of course, with all the seg-fund benefits available to you today. So again, please stay until the end of the presentation. I believe my presentation is getting CE accredited as well. So I always like to start my talk with a little funny here, and I came across this image of these three kittens, and they were just staring, blank face. And of course, introverts at a social event, they seem overstimulated, and they're all trying to figure out how to leave early. So that's my little funny for you all today. So I'm going to talk about the MER and the fee conversation. Like, what are your clients actually paying for when they're paying a management expense ratio? So seg funds, they may have higher fees than mutual funds, but again, they're both professionally managed pools and with a mandate and focus on capital preservation and sustainable market growth, as you heard from Patrick and his team. I'll also touch upon the additional guarantees and features at the end, but I'm going to break down the MER and what your clients are actually paying for. Of course, all the pooled funds that we distribute, whether they be mutual funds or seg funds, investment funds in general, have an MER, and that is the cost of managing and operating the fund. And again, this MER is calculated as a percentage of the net assets paid by the fund as a percentage of its total value. Unit holders, you're not invoiced separately for this. It's an embedded fee behind the scenes, and these fees and costs are withdrawn from the fund itself. Seg-funds, of course, have the additional insurance wrapper fee, which provides the 75 to 100% guarantee, which I'll talk about a little bit as well. So part of the MER pays for the investment management fees and, of course, the trailers, the compensation for all of you as the advisor. Sales commissions and trailers are usually up to 1% of the fee. And of course, this fee is shared by the advisors and us as the MGA and dealer. All of you advisors on the call today, the costs are very high for all of you to run a business. And also for us as the MGA, things like accounting, compliance oversight, sales and marketing, the systems that we all run and you all run as advisors, administrative, and all your other overhead costs that you all have as a small business owner. Someone like a Patrick Blais and his team, they usually collect about 0.8% of the fee. This fee is paid to the portfolio manager and their team of analysts for what they do for managing the fund, their ongoing research, decisions to buy, sell, securities, bonds, go to cash, and all that, and along with their expert advice. Now, experienced portfolio managers, they're usually CFAs, and they're really all hands on deck on a daily basis and constantly themselves. They're analysts, they actively manage, they're doing the in-depth research and really tracking the fund. And as Patrick was saying, managing the risks with their access to a wide range of data. Sometimes it's their own, sometimes it's third party. But again, and they're also doing the in-depth interviews of company executives and major shareholders to be sure that the companies that are in the funds are on the right track. And sometimes there's a custodian or another company that manages the administration of the fund. And of course, there's a cost to this as well. And also the general oversight and the compliance by the life insurance company that is managing the segregated fund. And there's also operating costs involved. Taxes are one of them. Taxes make up about 25 bips or 0.25%, which is paid from the MER. There's custodian fees as well when you're managing a fund. And of course, legal, accounting, and any audit costs. And again, we have to deal with the securities commissions and regulators for filings and reporting of the funds and preparation of the great T3 slip on seg funds, which accounts for every taxable disposition within the fund. Again, accounting, general administrative, sales and marketing costs of the life insurance company. So all in, the operating costs is about 0.5%. And this is how we kind of get to an illustrated example of a 2.3% MER on a fund. So again, to recap it, 1% for compensation, 0.8% for portfolio management, and 0.5% for operational. And Graeme and I and our team, we really do encourage advisors to talk about the costs because the industry is really trying to, beat up on managed money these days. Like we see all the ads, on the radio, on TV, attacking the fees, which I'll talk a little bit about as well. So again, it's great to bring these fees to the table and talk about these fees. And one of them, of course, is the insurance fee, which provides the principal protection, 75 or 100%, which we have, death or maturity. But really, these fees have come down drastically and actually quite dramatically over the years. And sometimes these fees are only 20 basis points compared to the identical mutual fund. So no longer do we have the super high insurance wrapper fees on the seg funds that you all distribute. And also too, today, there's a lot of focus on 100% death benefit. As there's been many millions of dollars that have been topped up to countless number of unit holders across Canada when sadly they pass away when the account is underwater. All the insurance companies will do the 100% top up if that option is selected. I talk a lot, and Graeme and I talk a lot about the power of a 10. Many of you have seen our talks on it, about the 10 key and unique features. And again, once you explain these benefits and features to your clients, oftentimes they'll see this additional fee of great value. And once again, this presentation, we do have a separate talk on it as well. So I'm not going to go into these benefits today. And again, my slide deck will be made available for those of you that request it from Graeme or myself. But a lot of what you get in the MER that's what pays for the value of advice. And of course, the unique features that we have in seg funds. Now, the benefits of financial advice today are now very well recognized. There's been a lot of independent research, academic studies as well, that higher levels of wealth are achieved by those who use advisors and don't try to do it on their own, right? So they use advisors on an ongoing basis, and these investors have better savings habits and are more confident in their ability to meet or sustain their retirement income needs. And some of these research and academic studies, I show on the bottom there, Morningstar in 23, IFIC in 22, Investor Economics 3 years ago, and also Advisor's Edge. So there's a lot of independent research on the benefits of using a financial advisor like everybody on this call. And the studies also show that financial advisors are paid for the advice that you give to your clients. And it's been proven that working with a financial advisor will add from 2.75% to 4.2% on the overall returns of the client portfolios. And again, the seg funds, we have the power of 10 with the guarantees, the privacy aspects, potential for creditor protection, cost savings, control that you can do with seg funds, simplified tax reporting on the T3, the time we talk about, quick payouts upon death, and also avoiding many traps and pitfalls with the planning that you can do with seg funds. And this is all around being able to name a beneficiary. And again, the reason why we can all do such great planning with seg funds is because the way the seg fund is structured and the different parties of a seg fund contract with owners, contingent or successor owner, which you can appoint, also the annuitant, which we call the measuring life of a contract. We can also name a contingent annuitant. Beneficiaries can be multiple. And of course, we also have the annuity settlement options, which Graeme and myself, we can talk about at a later date. So oftentimes, you can do a pitch to a client and the professional advisors, and they'll say to you, you know what, we love the features and benefits of seg funds, but the fee is still too high. So when you hear that, that's okay, because in the past 5 years, we now have 7 of the major life insurance companies that you all deal with that have fee-for-service seg funds. So if fee is still an issue, we can go to fee-for-service. And the 7 companies, I listed them there, are BMO, Canada Life, Empire Life, IA, Manulife, RBC, and Sun Life. So speak to Graeme or myself. We can help you structure a fee-for-service portfolio as well. And how those work, you have a base MER on the fee-for-service, and you negotiate with your clients a fee. And if you're competing with a brokerage firm or a private wealth manager, we can actually come very close or sometimes match these fees, yet provide them all of the seg fund benefits that you receive. And if that's not enough, most of the life insurance companies, actually all of them, have high net worth options. These usually start at about 250 or 300,000, and the fees come down as the accounts get higher. And usually at $1 million or more, these fees can be 50 basis points lower than the entry level on the funds. So again, fees are not an issue anymore in the seg fund world. And also what Graeme and I have uncovered are pricing inefficiencies where seg funds are on a 75-75 stripped down level, are very close to the mutual fund version. And I'm going to show you some examples. For registered accounts, and these are registered accounts only, we have RIAs, or registered investment accounts, available with 2 carriers, Assumption Life and Beneva, and the MER is exactly identical to the underlying mutual fund. So these are quite popular for registered accounts. And if fees are still an issue, we have available through Desjardins a market-linked GIA, and the MER on the basket of these stocks within the guaranteed advantage is a 0% MER. And these stocks are usually about 18 or 20 very large cap blue chip holdings with a 0% MER. And also, I've been saying to advisors for many, many years, don't focus on the fees. Of course, you focus on the benefits, but at the same time, you focus on net returns. For example, if you have a 7% net return with a 2.5% MER, it's actually not that bad, as opposed to a 5% return where the MER is maybe 0.5% or 50 basis points. So again, check the funds that you're marketing, look at the net returns, because the net returns is really what is the most important. So Graeme and I have uncovered a number of competitively priced 75-75 seg funds. And these are quite astonishing, actually, when we looked at them further. With Canada Life has the Mackenzie Canadian Fixed Income Balance Mutual Fund is 2.3%. But amazing, the seg fund version of this exact same fund with all the seg fund benefits is 2.15%. Equitable Life, world famous, been managing this fund, Invesco, for decades. Their international companies mutual fund, 2.88%. Seg fund version, 2.87%. With IA Clarington on the mutual fund side, they have a amazing high income mutual and seg fund. A mutual fund is a 2.35%. Seg fund, just 11 bips more at 2.46. Manulife, the global monthly high income mutual fund, 2.4%. Seg fund, 2.5%. Sun Life, their in-house portfolio management team at MFS, they have a diversified balance mutual fund, 2.18%, and on the seg fund side is only 2.22. So you can see from these examples that you don't necessarily pay more for a seg fund with some of the great portfolio managers out there. And the registered investment accounts I alluded to, with Assumption Life, they have a very popular Fidelity Canadian low volatility seg fund, 2.45%. At Beneva, Their best-selling fund is the AGF Canadian Dividend Seg Fund at 2.12%. So again, it's not like the old days. Those of us that have been in the business, 20, 30, 40 years plus, where seg funds had super high MERs. That is definitely not the case. If there's any questions, Graeme or myself, we can take these. Again, we encourage you to have the fee conversation with your clients. Don't ignore it. Just talk about it. Put it on the table, because the fee is only a very small portion of everything involved in wealth management, in financial planning, insurance advisor, and financial advisory. So definitely talk about the fees. The industry have always attacked seg fund fees, but yet, as Graeme and I have showed you in this presentation, they are very much in line with mutual fund fees, yet offer so many more benefits than mutual funds. And again, these features and benefits are second to none. Show clients that what you're proposing in seg funds is really an integral part of their financial retirement and estate planning, and help them with their goal setting, do the regular reviews, performance updates, and provide market insights. And again, as financial advisors, you can all manage your clients' emotions in volatile times, adapt time-tested strategies such as dollar cost averaging, encourage them to buy when the market's low and not selling out. Rebalancing, right? We've always said, to clients, the best way to rebalance is with new money coming in. So put the onus on your clients to continue to invest, and you will use that money for rebalancing. Again, dollar cost averaging, running packs on these accounts, and really building portfolios with the help of Graeme and myself that will really stand the test of time. So again, Graeme and myself, we, thank you for your business. We're having a great year on the wealth side. There's our contact information. And again, I will just open this up for any questions that we have. And once again, thank everyone so much for their time on the call today.
Alex, there's nothing in the queue right now. Been answering questions that came up, so I think we're clear to end things today. We're bang on time, and we started a couple of minutes late, but we're a couple of minutes over. So thank you very, very much. As always, a lot of thought, time, and effort has been put into producing this. It doesn't seem much for a 20-minute presentation, but there's a lot of stuff that goes on behind the scenes. So thank you very, very much. Thank you, everybody, from attending today, from Manulife and the team here. Now, obviously, again, the people behind the scenes that put these things together, that do the production work that you don't see. There's a lot of work happen. So thanks, everybody. Have a great rest of the day, week, and long weekend. We'll hopefully see you all soon. Bye.
Thanks, everybody. Bye now.